Welcome back to It's Only Money with financial advisor Scott Brown of Edgewater Family Wealth. EdgewaterFamilyWealth.com is the website. Tammy is here as well for all you fin heads out there. And good morning, gentlemen. How are we doing today?
Good morning.
Good morning. Fantastic. First and foremost, how is the poop house?
It's a work in progress. It's my Sistine Chapel at this point. I'm Poopalangelo, and it's and that's how it's work. It's just one thing gets done at a time. So we got the flooding done, taking all the waters out. Then the toilets had to get done, and now we're currently at the part where we have to replace the drywall. So very, very fun home ownership is. I'll tell you that right now.
It's the gift that keeps on giving.
Yeah, I like stocks more as an investment because I don't have to fix them. The washing machine isn't going to break on my Apple stock.
No,
I don't have to fix the hot water heater on my Tesla. I'm leaning more towards my home is not the asset that I thought it was. Feels more of a liability at this point.
Well, it certainly can be at moments, but long term, it'll all pay off in the end.
That's what I keep telling myself.
Yeah. Well, you hang in there. 30 years later, we'll talk.
Exactly.
It's always a long-term game here. So, yeah.
But we are here in this very dry studio. I basically have been living out of the station. And we kick things off the way we always kick things off. And that's with the numbers with Tammy. Tammy.
Hey. All right. Well, this week, actually, we are starting with some good news from the yields. We're seeing good numbers for the 7 and 10. Those are mostly the government that pays yield for all their bonds.
7 and 10-year treasuries?
Yes.
Yeah.
We're looking at 3 and almost 3 as well. So that's your risk-free almost rate.
Yes. Okay. So 3%. I mean, that doesn't sound particularly sexy in the big scheme of things, but comparatively, at least in the context of the last decade or so, pretty darn good.
Very much. Yeah. Even 2 years ago, that was almost half of it.
Yeah.
So that is, as you said, very good. And now the CPI number, though, the inflation that we got this week wasn't as great as we hoped it would be.
A little sloppy.
Yeah, a little sloppy. But it was not as bad as we see all around.
But we do know that there's a little lagging in that number because we saw commodity prices crash. We're seeing lumber come down. We're seeing housing slow down. We're seeing a lot of areas slow down. I just don't think it's reflected in the math yet.
Yeah, it is lagging indicator.
Yeah. So we'll get there. Everybody relax. Take a deep breath. It's Friday. Have a drink. It'll be cool.
Absolutely, yeah. Speaking of which, for the inflation number coming out here, I-bonds, like the I-series bonds, now are paying about 9.6.
Oh, so now you're going to get, what you're going to do with that is you're going to get a lot of people to call because 9.6 sounds sexy to people. And I-bonds, for the people who don't know, are government-issued bonds that you buy directly from the Treasury. I don't even think you can get them through an advisory firm, can you?
No, it's directly through.
It's direct, so you got to call 1-800-bureaucracy to get your I-bonds. But and it's actually a worthwhile endeavor. People will get all excited about it. Now they do limit you. Am I not correct, Tammy? To about $10,000.
$10,000. Yeah.
Yeah, about $10,000 per Social Security number. But if you can gather them up, you and your spouse,
couple kids,
get the kids on board. Get grandma to get involved, you might be able to gather up a decent number of them. But that's a variable rate. Am I wrong about that?
There is a variable rate component in it.
Yeah. So it changes from time. But right now, not too shabby.
Not too shabby at all. Almost 10% here, 9.6. Very good. And that's for 30 years maturity.
Yeah.
Very good. Now, for houses, as you said.
So wait a minute, 9% for the entirety. So is that 9% locked in for the entire 30 years?
No, there is a portion of it, as you said.
The variability. Okay. Yeah, because in my head, I'm thinking, all right, 9% over 30 years, your money's going to double every 4 or 5 years. That's a good chunk of, you could have a couple $100,000 at the end of the road.
If it is fixed.
If it stays at 9%.
If it stays at 9%.
Yeah.
Give me one of those right now.
Unlikely. All right. Sorry I interrupted. Go ahead.
No worries. So to the housing, though, as you mentioned, with the slowdown.
Yeah.
I thought we're looking at the Orlando metropolitan area since we all are here.
Yes.
And we compare
very metropolitan.
Very metropolitan.
To the national average. And we want to see the median listing price, the change from month to month. We see that month to month in Orlando, median price went up 3.2%.
Month over month?
Month over month.
Wow, that's a lot.
Yeah.
But is that true nationwide, though, or is that kind of limited to the Florida markets?
That's Florida market.
Yeah.
Nationwide, less than, almost 0.5%.
Yeah, so it's slowing down.
It is
The
slowing.
growth is slowing down. There's still growth.
Still growth.
Yeah, it's still growing, but it's not growing at the ridiculous pace it was. And eventually, we'll probably see that number turn south for a minute.
Absolutely.
My theory is just like people get here and then maybe their family is ready to move and the first wave of the family gets here and they're just like, it's so hot. Don't come here. We've made a mistake.
Especially right now, right?
I can't even believe it. I mean, like, I think the other day it was the hottest it's ever been since 1872.
Yeah, I remember 1872. That was a hot day.
That's the Wild West.
Yeah.
They just invented the thermometer.
I
They're like,
don't
it's the
care.
hottest day ever.
I don't care. I'll pay taxes. I'm going back to New Jersey.
Exactly. But everybody moves down here. I mean, like I see everybody in my neighborhood. They're all from the megalopolis area of the north, and they all feel like they're escaping something. I'm unsure what it is, but I'm always like, you're not fully prepared to live here.
Yeah, no, you don't know what's A, we have alligators.
Yeah.
B, it's very hot.
Yes.
Were you aware of these things? And again, that makes them question: should I go back and pay those taxes that I didn't like? So so it's yes, but in 6 months they'll feel good about it.
Yeah. I get a lot of these questions from my friends up north. Like, oh, how often do you have an alligator in your kitchen?
Sometimes.
Yeah. And I say, well, it depends why you ask.
Yeah.
I've definitely seen them in pools before, like just hanging out. Like I don't live near a lake, but I live close enough to one. Before I jump in my pool, I definitely check for alligators. No joke.
I think that's reasonable.
Yeah, because I don't have a screened-in porch, so they can if they found a way to get in there, they could.
Ah, yeah, that's true.
We digress again.
Alligators are not part of the numbers.
No. It shows about money, right? I forgot.
Yeah, sometimes, yeah. To continuing on, the S&P, the market in general, kind of faring, it's getting up from the lowest point it has been.
What was the low point?
So far, the lowest point was 23%.
And how long ago was that? Do you remember?
Like
A few weeks?
In like 3-4 weeks ago.
Okay, so it was down 23% a few weeks ago. Go on.
Yeah, so now we're seeing the up, and that's what we call the max drawdown. We talked about that the previous week. So who knows? It might even continue to go up.
But where are we now? We're down what?
We're down 19%.
So we've got in the last few weeks we've gotten 4% back, right? So as per your description of the treasuries, it would take you a year plus to earn that money. It would have if you just said I'm out at down 23%. I can't take it anymore. I'm tapping out. You take your money, you put it in a treasury, earning 3%. You think, well, that's great. So in a year and a half, I'll have made 4% using loose math, right? But if you'd have just stayed in 4 weeks later, you'd have made 4%.
Oh, precisely.
Right. So this is where people get kind of cattywampus, right? They're like, I'm down. And then they may complain at the end of the year, look, I'm still down 10%. But yeah, right. But you were down 23%, and that's how the market works. It grabs back losses in big chunks. And if you get out, you're liable to miss one of those chunks, spending the next 10 years in something fixed trying to make your money back.
Exactly. That's, remember, Scott, what we do in the office when we measure risk and volatility. That's mainly for the viewers, or actually listeners in this case.
Yeah.
That basically is what we do. How do we measure that for the next year and the year after?
Right. And for, Ryan, a good way to look at it is the risk. A lot of the risk is gone, right? That's not to say there isn't more risk, but if you said there was some risk a year ago, and now we're down 18%, doesn't it make sense that a lot of the risk has been removed from the equation?
Because you're buying at the bottom?
Well, maybe not
not the bottom, but you're buying at a low.
Yeah, that is you can't debate that, right? If you say I say to you, you're buying at a low, you can't say, well, no, I'm not. You are buying at a low. Is it the ultimate low? No, but that's a fool's errand. Nobody can pick the ultimate low. It's been tried many, many times over centuries, and it just simply doesn't work. But what you do know is you're getting an 18% discount off of whatever it is, Microsoft, Apple, Tesla, whatever it is. Well, Tesla.
So it's like it's on sale almost.
It is on sale, and it's the only sale people don't like.
Yeah.
That's bizarre.
That is very interesting because I know I listen to you and I'm like, okay, I'm gonna go with the S&P 500. I'm gonna stop just picking stocks and going crazy like I do, but then I pull up the 5-year timeline and I'm like, well, the lowest it ever was like $269, and the track of it is still like in a downward motion. It'll get that low again, so I set a buy order for $270, thinking I'm a genius. It's not going that low, though.
Yeah, so then it gets to 271, never touches your buy order, and shoots back up to 400. Brilliant!
And I've missed out on everything.
You are brilliant.
No,
Thank you.
So what you're saying is I should take it permafrost and just get it at the sale price now. Sure, it might be, I get it 18%, but it might go 22% off.
Yep.
But, that's the fool's errand.
That is a fool's errand.
Interesting.
Take that, Warren Buffett.
Yeah.
Anyway.
Yeah, and lastly, we just kind of look at a micro level on the industries that we have within the market just to see how they're doing. And we see that year to date, they're all down, obviously, but very interesting ones. We have food, beverages actually slightly down from the year to date.
Really?
Yeah.
The price, the sales or pricing?
That's the
Cost.
market shares for the companies.
Oh, gotcha. Oh, you're talking about stocks themselves are down.
Still talking
Okay,
about stocks.
interesting. So like Pepsi, Coke,
Yeah, so food, beverages
McDonald's.
would be McDonald's,
Yeah.
for example. You're talking about,
In Apopka, they say McDonald's.
McDonald's.
I'll add it to my dictionary. Yeah, but we still have like stuff like pharmaceuticals as well, in general, the sector. And, well, this one is not surprising. Air and defense.
Doing well.
Yeah.
Strange.
I mean, comparatively.
Wonder
to the
why.
rest of it.
Coincidence? Don't think so.
Yeah.
And that's but is that pattern seeking though? As a human, I'm going, well, there's war, air and defense goes up, or that is what happens.
No, that is pattern seeking because it's too late. Before Russia invaded Ukraine, had you bought energy stocks 6 months before, you didn't know it was going to happen, but you just owned them as part of a diversification, then you would have benefited from this. If you say, well, now Putin's knee deep in the Ukraine and I'm going to buy Lockheed, it's too late.
Too late. And that's the good kind of financial advice that you're going to get all morning long here on It's Only Money. Make sure you check out the website, edgewaterfamilywealth.com. And we'll be right back with more Scott Brown and It's Only Money here on Real Radio 104.1. Welcome back to It's Only Money here on Real Radio 104.1 with financial advisor Scott Brown of Edgewater Family Wealth. EdgewaterFamilyWealth.com is the website. They also have the blogs there as well, where you can see the financial talk with Tammy for all you fin heads out there. Plus, you can email us EdgewaterFamilyWealth at RaymondJames.com. And we were knee deep in the numbers. Are we still in those numbers, fellas?
We're in the numbers. I got some numbers. Actually,
Scott has numbers.
have
I
numbers.
actually have numbers.
Wow.
Okay.
And you know what? That's a lie because Tammy gave me these numbers. So I have Tammy's numbers.
Oh.
But we were. I was reading an article about taking income in retirement, and the gentleman who wrote the article, I thought it was a really good article, talked about, because that's a large part of our business, Ryan. Is a client will come in, they're ready to retire, they have a bucket of money, and they say, I need income. I no longer am putting money in the bucket. I now need to take money out of the bucket. I'm dating myself, but we used to call that in the business mailbox money, right? So we'd send a check to their house every month, and that's what they lived on. Because once you quit work, I don't know if you're aware of this, but once you stop working, they stop paying you.
What?
Yeah, I know.
Thanks, Obama.
It's oh, lovely. So with that said, the article went on to talk about why it's true that if it's better for you to sell or spend your money monthly rather than annually, because every chance you take the money out, there's about a 57% chance a 60% chance on a monthly basis that the market's going to be positive, and only a 40% chance that it's going to be negative. So on average, you're selling at highs more than you're selling at lows. Does that make sense?
Yes.
So I started thinking about this article, and I sent Tammy a text, and I said, hey, man, I got a question. I'm curious about something. What percentage of weeks, months, quarters, and years dating back, say, to the 60s are positive, and what percentage are negative? Because if I ask you, Ryan, your perception, the way it feels to you because of media and things like that, does it feel to you like we have more negative years or more positive years?
It's an interesting question. I mean, I've lived now through several once-in-a-lifetime events.
Mm-hmm. Me too.
So, but we had a big 2008 bad time, sort of having a bad time currently. But I would say most of all positive.
Yeah, and you're right. You're right. But what most people would say the opposite. I've kind of brainwashed you at this point. So that's your answer.
You have. I would not have answered this question the same way 18 episodes ago.
Correct. So when I talk to most people, they're like, well, the market's just all over the place. No, actually, it's not. You're incorrect. Because 74% of all years, so better than 7 out of 10 years, the market historically has a positive return. And if you ask most people that question, they would get it wrong. They would say it was the opposite. Most years are down. And why is that? That goes back to something we talked about in early episodes, which is people feel negative returns or pain twice as heavy as they feel pressure, meaning again, or pleasure. And what I mean by that is if the market's up 10%, they feel good. If the market's down 10%, they feel awful, right?
Yeah.
And we laugh, but that's from an evolutionary standpoint, there's a reason for that because we want to be alarmed when bad things happen or something comes to eat us or we don't have enough water or food or whatever. That's hardwired into us. But that doesn't change the actual math. The actual math is of all weeks, when you start on Monday and you get to Friday, 57% of all weeks throughout the year are positive. When you do monthly, you start at the 1st and end on the 30th, 60% of all months are positive. When you do quarters, 3-month periods, 35% are negative, 65% are positive, and when you look at years, only 24% of all years, 2.5 out of 10 years, are actually negative returns dating back to the early 60s. So my point is, when we get upset and when we say it's a bad market, and let's say 2022, which is obviously at this point is very likely will be a negative year, statistically it's unlikely next year will be. It's like you're in a game of cards and you draw 3 kings in a row. There ain't a real good chance you're getting that 4th king, right? Statistically, the probabilities are very low when you look at the history of the deck or the deal at that moment. And the history of the deal with the market is that if you have a negative year, not that we have never had back-to-back negative years, but the statistical likelihood is not very high.
So that's why so there's people that would they can take all their money all in a year, like a big lump sum.
Mm-hmm. Some
and
people
then
do.
Some people do it monthly. And you're saying it's better to go monthly because if the chance of landing on a bad year is actually higher?
No, it's not higher, but you're just, again, it's just a matter of when you take the money and how often you take the money. And in our case, and I know that's a little bit of a convoluted statement and it's a little hard to go to on the radio, but I would say that just overall, let's agree that doing it regularly makes sense, whether it's annually or it's quarterly or it's monthly. But the point being is when you take it in the year, you got to be a little more right, if that makes sense, than if you just take it all the time, because then you're spreading out the risk to some degree. So I realize I've got myself in a hole here, but it's a little bit of a complex situation. But no, in the end, really the main point is, the reality is that more weeks, more quarters, more months, and more years are positive than negative.
Well, that's one thing I didn't really understand, and you kind of explained it to me during the break, is it's going to go up, and it's going to go down, of course, too. But then it's going to go up again, right? And then it's going to go down. Am I correct in saying, though, just the way the economy and the market works, but when it goes down again, that down is generally higher than the last down before it?
There you
right?
go. It's a higher low. It's always a higher low. Historically, so far, it's always been a higher low.
So you're still making money, even in the down, just not as much as that if you caught it at that upswing.
Well, you're always going to make money as long as you're patient, right? That's the moral of the story. If you say, well, if I asked you today, the market's at 30,000, is it going to 50,000? Your answer is what?
Eventually.
There you go, right? So if you hold that belief, which historically has been true, that the market's gone from 1,000 to 5,000 to 10,000 to 20,000 to 30,000, but in between it went down, and you believe that pattern's going to hold true, then you invest for the long haul, you're patient, and you have process. Not to say you don't make changes along the way, or there's an opportunity in munis, or you like a particular stock you like long-term, whatever, Tesla's good, Tesla's bad. That's all part of it. But at the end of the day, the big picture is you're buying at 30,000, and we believe in 20 years the market will be at 50,000. And if you believe that, the fact that it went to 35,000 and back to 28,000 is inconsequential, Because again, going back to the doomsday mentality, right? Tammy, people will say, it's different this time. Okay. But again, what is the alternative? The alternative to the market going from, say, 30,000 to 50,000 is it goes to zero. It's a binary conversation for you because zero is a different ball game, right? We're fighting in the streets. We're throwing rocks at each other. That's the world we would be living in that scenario. So it doesn't matter what you do with your money in that case. So if you have the belief that things will continue in fits and starts and capitalism is messy and the world is messy and there are wars and there are bad things and there are hurricanes and all this stuff happens, but the market will still, as it has always done, get from 30 to 50,000. Then having these ridiculous conversations about the world ending and I'm going to own the right thing. No, be patient, build a proper process from the beginning, and stick to it.
It's so, but that like I've said before, it's so hard when I essentially have the app on my phone and I can make life-altering decisions with like 2 clicks. You know, like I can. There's a version that this tiny machine in my hand can ruin my life in
many
3
ways.
Clicks right now.
Yeah,
financially. But I guess in a lot of ways too. There's like I could ruin my relationship. With my fiance.
You could upset the neighbor about politics.
Yeah.
Who could come over and shoot you. There's all kinds of things you could do.
This little box is too much power,
it's
Scott.
A lot of way to go, Steve Jobs.
Yeah, but that's what I love about this show is like you've taught me like don't even look at it every day. If you like what you like, just stick with it, and one day you'll be pleasantly surprised.
Well, and I hate to admit this, but sometimes clients will call me up and it's like 1:30 or 2, and I'm doing whatever I'm doing. They're like, well, rough day in the market. And I'm like, oh, crap. What's the market doing?
Scott, you're not supposed to say that part out loud.
I know it, but I got things to do, man, and I don't control the market. And I've grown in 35 years. I've grown accustomed to not controlling the market. It doesn't. The randomness. Human beings, and we could talk. This is perfect segue. I've been reading this book, Think Like a Monk, by Jay Shetty, which is, by the way, please read it. And I was thinking you should invest like a monk. Monks don't show, right, their whole thing is not to let emotion control them. They're minimalists, of course, so the stock market would be lost on them. But the reality is if you operate out of fear, monks learn not to fear fear. And one of the things Shetty talks about is learning to manage his fear, because our fears are of punishment. We don't want to be ashamed or embarrassed or humiliated or fail. And I think when people react to markets, if you're worried your spouse will be disappointed in you because you've made a bad investment, or your parents will find out you had a bad year in the stock market, or you can't go to your softball game with all your buddies and over beer brag about a stock or bond that you bought or a trade you made or something economically that you understand that they don't understand, right? Because you did your quote-unquote research right? That is what people fear. They fear all these implications that generally, if they just let well enough alone, either worked with a professional or don't. This is not me making a case for working with a professional, but having a process and following the process, let the fear go. That's what drives most conversations with money is fear. Fear of not having it, fear of making a bad decision. Most people don't go wrong by making bad decisions. They go wrong by not making a decision to begin planning, right? They make that decision. This is a decision I've made. It's a hard decision, so I'm not going to make it, right? So again, planning, process, and discipline are no different in investing than they are with your health, with your relationships, or your life.
Oh, yeah. I used to be the king of like, this is too complicated, so I'm just not going to do it. And when it comes to this, just what I've learned just on this show, it's far less complicated to be good at this, or like to make the money. And I want to talk to you when we come back from break about you being a financial advisor and just taking the reins on something that, like, if you're a guy that, like, you're out there, you got your business, you don't need to think about it all this on top of it, right?
That's what I would think.
And I want to speak to that when we come back, because I think that's something somebody explained to me recently, and I was like, oh, that's a good book. I got to tell Scott about this. So we'll be right back with more It's Only Money here on Real Radio 104.1. Welcome back to It's Only Money here on Real Radio 104.1 with financial advisor Scott Brown of Edgewater Family Wealth. EdgewaterFamilyWealth.com. FinraWealth.com is that website. Tammy is here. I'm Ryan Holmes. And as we were talking before we went to break, it was a conversation that I had with my fiance where she wanted to get rid of a bill, and it was the lawn bill. And I said, no, because if I'm out there doing the lawn, that's time away from me doing my real job, which I like to think like my real job is just creating comedy or content or whatever. That's time I'm not spent thinking. That's time I'm exhausted. I'm tired. It takes away. So that $100 bill once a month, I say, is an investment in my time, because there's stuff that I'm just not good at. The lawn guys do it well. And I was thinking this about financial advisors. Like, I don't know the intricacies of the market like you gentlemen do, obviously. And you know the stuff for tax implications, just where to invest, how to invest, all the different types of products that exist. Whereas I'm just a guy with an app on my phone. I'm generally not going to win in this situation. So just hand it off to somebody like you gentlemen, who it's going to be in very good hands, then takes that mental energy, and I get that back myself, where I can invest my time and focus on something that I am really good at, thus making myself better in the long run. And is that the reason most people come to you, or they're just trying to make money, or what is it?
No, I think you've hit the nail on the head. I don't know that most people could articulate what you just said. I don't know that they've processed it that far. But yes, what you're doing is you're leveraging your time, right? So if let's say you've calculated you make $100 an hour doing comedy, being involved in the Monsters, doing your kettle corn, whatever it is, right? And you say, I'm worth $100 an hour. And then you calculate the cost of using a financial advisor, which most people don't do the first part of the equation. They just go, it costs this. I don't want to pay that, right? They don't do the first part of the equation to say, but if it costs me $3 an hour of my, throughout the year, if I do the calculation, how much time, et cetera, or even $20 an hour, or even $50 an hour, that's 50. If you're worth 100 and I cost 50 to do this thing, you're better off doing your thing and letting me do this thing, because that's a net gain of $50 per hour. That's how entrepreneurs think. They think, what is my time worth? If I'm a doctor, a lawyer, a business owner, or a high-paid executive, or, a plumber who makes $80,000 a year, which many of them make that and more, right? You say, well, my time's worth $200 an hour. Do I really want to spend $200 an hour of my time to handle my finances, build a process, check on the tax implications, call when the form's lost, call when there's an IRA distribution, call when I need a beneficiary change, that could on average take you a few hours a week every year, right? So what is that worth you? And then people will say, well, I do it in my spare time. And that's when I really get confused, because when I think about my time and what it's worth as a entrepreneur and a financial advisor, it's considerable. And then I think about my free time, right? I say, well, first of all, I don't mow my own lawn, I don't change my own oil. There's none of that stuff, because first of all, I suck at that stuff. Second of all, it's not. I'm better off paying somebody to do that right, because when I was first married, like everybody, I didn't have any money, and we're trying to fix up the house, and I'm a carpenter. I'm sanding the floors with a little belt sander, and it's taking 8 weeks, and I'm sweating. It's awful. It looks bad anyway. My wife's pissed. The plumbing doesn't work. The toilets, when you sit on it, it practically falls. I did all that. Mm-hmm. And then I realized there are people who are better at this than me. But when you get to the idea of your free time, that's where I really get sideways. Because if you say to me, as a person, my time's worth $100 an hour, but my free time's worth nothing, I would argue my free time is worth twice.
Yes.
What my time with my kids, with my wife, with my family, at the park, playing golf, riding my motorcycle, whatever it is. The whole reason I'm working is for that, right? If the whole reason you're working is so that you can then call, 1-800 investment shop, that's weird, right?
Yeah.
If that's what you're, I'm not saying people don't enjoy that. Some people, oddly enough, do. But it's very few people. And if you can't wrap your head around the leverage you get from working with, listen, you could subscribe to the Harvard Medical Journal, and you could read medicine books, and theoretically you could, do your own medicine, right? I'm pretty sure you'd get it wrong most of the time. And the amount of time,
devastating results.
Doctors, you could die. Doctors go to school for like 10 years. Leverage their time and their expertise. So yes, the answer to your question is, Really what you're leveraging is time. If you go to a financial advisor and your thought is this person, this man or this woman is going to pick the best stocks and therefore I'm going to earn the best return. That if that's what you think, you're going to be sorely disappointed because while, yes, we do have more insight, I have a guy like Tammy in my office who's a CFA. He's really smart. He researches stocks. He back tests them. He looks at their price to earnings. He looks at all kinds of intricate algorithms and thoughts and back testing and charts and graphs and arts and crafts, and he knows all that stuff, right? But at the end of the day, we're going to be a little bit better than you at that. What we're really good at is you sold a piece of property and you're looking for a tax loss. What we're really good at is where did that form go? Let's find it. What we're really good at is how do we get the trust put on the documents? What we're really good at is no, you can't sell right now because the market's down. What we're really good at is the psychology, the administration, the tax implications, the conversation with your accountant, the conversation with your estate attorney. We are kind of the quarterback if we're doing it right. If an advisor is doing it right, they are your quarterback. They are your teammate. And I think that's where people go wrong is they think they're somewhat adversarial about it. People have very strong opinions, I've noticed, about financial advisors. Somebody finds out what I do, one of two things happens at a cocktail party. Either they talk my ear off about some stock trade they claim to have made zillions of dollars on, which I know isn't true. Or they're like, oh, I'm paying for it. They kind of look at me funny, like I wouldn't pay. I'm not paying. I'm not letting you trick me. Well,
yes.
All right. Well, get out of the way because I'm trying to get a cocktail here. So, that's where people go. It's totally binary to them. So if you go into the conversation, you walk through the door at the advisor's office and you say, look, I'm looking for a partner. I'm looking for somebody to tell me the truth. I'm looking for somebody to save me time. I'm looking for somebody to redirect me when my own reptilian brain gets in the way. These are the things we're very good at. And, I've tried over the years to write down and think of all the things we do and the things I do throughout the day, the phone calls I get from clients about this, that, or the other. And it's in the hundreds of things that I deal with on a monthly basis.
Do you ever have to just basically have to slap somebody's hand away from the button? Like, what they want to do right now, you're like, that is a terrible, terrible financial decision. I mean, obviously they're in control of their money, but I imagine a big part of your job is just being like, no, bad. Sit.
Yes.
You wait, you sit.
Well, that's a big part of it. And it's funny because right now as the market's misbehaving, I talk to a lot of clients and every client says
I bet you talk to them more when it's bad, right?
Well, that's where I'm going. So client will call me up, one of my clients and say, oh, how's it going? I bet your other clients are just driving you crazy because they all think it's the other client, right? Everyone that calls me, I get 10 calls in a row and they all go, oh, your other clients must be driving you crazy, right? So there's two things going on. One there, they don't think they're driving me crazy, which none of them are, to be honest with you. But they also are kind of saying, are other people scared because I'm a little scared, right? That's what they're saying. So... but the truth of the matter is they're not. Most of my clients I've had, not all, but many, I've had for 20, 30, 35 years, some of them. And they've heard the lecture so many times, they're not even bothering to call. And I also think that they've grown accustomed to the fear. And what I mean by that is they've been through so many storms, and sometimes they reacted poorly, sometimes they didn't. They've started to tone down their fear. They're less fearful during each preceding or following storm that comes. If they've been through 7 or 8 market corrections or 2 or 3 market corrections, by the 4th or the 5th one, they understand that the wind's going to come up. They understand the noise is going to come up. They understand all the things that are about to occur. It still makes them uncomfortable, but they react better. There's a story in this book, Think Like a Monk, talks about the biosphere. Remember the biosphere in Arizona they built?
Yes.
Where people lived in this little dome thing, and they grew trees in there, and the trees kept falling over, and they couldn't figure out for the life of them why the trees were falling over. Stay with me, I'm getting somewhere. The trees kept falling over, and they realized was the trees were never, when they were little trees, they never felt any wind. So the root structure never grabbed because it never felt any. And once they would get big enough, they just fall over because the roots had never been tested or stress tested enough that the roots grabbed deeper and deeper and deeper and deeper as the tree grew. And the point to that is every time you are fearful, especially in markets, you get out. You were 22, you got scared, you got out. And then you were 28, you got scared and you got out again. And then you were 35 and you got scared and you got out again, right? You never learned anything. Your roots never grew. Your roots never grab the ground. And what I'm saying for people who have been through this numerous times, with me or not with me, their roots have grown deeper and deeper and deeper, and that's why they're more and more successful as time goes on.
Yeah, that's actually a really good analogy. That's why I'm not afraid of full-on market crashes, I think. If with coming up with the year that we have, and obviously pandemic and everything, but I lived through 2008, and I was broke, crazy broke, but I learned to live a sort of meager existence, and I was like, oh, I can get through this. Mm-hmm. And then coming up with this one, even though the news media throws at you like it's falling apart, but talking to you, I know it's not. But I'm like, if it happened again, I could do it. I would know what to do. You hold on, and it will get better again because it's historically just always gotten better. If the 1812 is objectively worse than 2022. You know what I mean?
Yeah, without a doubt. And again, if you believe otherwise, then you're in bunker land, right? If you believe this thing we call America, which is a bit of a mess right now, but let's be fair, it's been a mess before. If we follow the Winston Churchill thing where he said, America always gets it right after they try everything else first. If we believe this thing called America is going to endure and we're all eventually going to get along and sing kumbaya and all that sort of thing, and capitalism is real, albeit messy, if you believe these things as I do, then you're just hanging on for the inevitable value that comes at the end of the process.
And if you would like more amazing analogies, advice, things like that, stick around for more It's Only Money here at Real Radio 104.1. Remember, EdgewaterFamilyWealth.com. That's the website. And you can send us an email with your questions to EdgewaterFamilyWealth@RaymondJames.com. We'll be right back with more It's Only Money here on Real Radio 104.1. Welcome back to It's Only Money here on Real Radio 104.1 with financial advisor Scott Brown of Edgewater Family Wealth. EdgewaterFamilyWealth.com is the website. We have Tammy here as well from Edgewater Family Wealth, and myself, Ryan Holmes. And man, we're talking a little bit about how it feels like the media is purposely trying to scare you sometimes into thinking it's almost like how weathermen want a hurricane to happen. You know what I mean? Because then it's their time to shine. And it seems like mass media, it's like they're trying to scare you a little bit for some reason. And when it comes to investing, it seems like the opposite is true. Fear is a good motivator to not get eaten by a lion, right? Mm-hmm. You're super careful in a forest because the lion's there, right?
Yes. You freeze.
You freeze.
Yeah.
But I believe, and correct me if I'm wrong, that's not the approach you want to take when it comes to investing.
No, I mean, it comes back to modern. There's so many analogies you can use for how our brains have not kept up with technology with modern day life. There's many societies that have failed due to this factor, right? Mayans and Romans come to mind, right? So, yeah, fear is a motivator. I mean, fear really, we have an entire industry, two industries that I can think of that are based on fear, right? Media and politics, right? Politics is 100% fear-driven. Those other people are going to do bad stuff to you if I don't get elected, right? That is the entire, you can shrink it all down to one thing, right? I don't know, you can talk about education and immigration and economics and all these other things. But at the end of the day, the pitch is these bad people are coming for you, and I'm going to protect you, right?
Yeah.
Vote for me in November, right?
Barbarians are at the gates.
The barbarians are at the gate, right? So that works on our primal brains. It works on our reptilian brains. And the same is true of the media when it comes, because, again, I've said this to the point where I'm sick of saying it. The reality is if somebody comes on the news, whatever your news du jour is, whatever your flavor of news you like to get, and they say, hey, listen, markets are down a little bit today, but, historically everything works out in the end. Why don't you just go on a picnic? People are going to be like, click, 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 click. Let me find somebody who's upset so I can listen to them, right? So
I think that even worse, it's like, this guy doesn't know what he's talking about.
He's an idiot. That guy's an idiot, right?
Everything's going to be fine. What kind of moron is this?
This is, what world do you live in where everything's going to be fine? We're all going to die. Did you know that?
It's not stimulant enough.
No, it doesn't get your cortisol flowing in your brain, man. You don't, that's how we sell, the world's going to end. Bunker Products by Jim. That's what we get, right? So Yeah, but fear is very motivating. If we don't learn to deal with fear, they've done studies on people, your ability to, once your fear mechanism kicks in, when your body shouts fear to itself, whether that's because stock market's down or the economics are bad or you're in a life or death situation, your mind can no longer tell the difference between a real threat and a not real threat, right? Once you've reached that point where your adrenaline is kicked in, and for different people, it's different levels. For some people, it's just, oh, crap, my stock's down $1, and then they shut down, right? They're like, oh, I got to sell bad things, honey. They're screaming through the house, right? For some people, it's a higher threshold, and the reason, that's why we have, when you go into the military, they train you, right? You go through gunfire, they explode things around you, so your fear threshold grows and grows and grows, so you don't panic. And you can still, that's why special operations people are so good in bad situations, because they've been through 1,000 of them, either simulated or real. And so when something bad happens and the bullets are flying, they don't freak out and run and look for something to hide under like I would do, right? They just go, all right, well, it's game on. Let's see what we're going to do. Let's see what the manual says. And they go about their business, right? And thank goodness they do. People do that with stocks. So until you train your mind to be more disciplined when it comes to the ups and downs of the stock market, you're always going to overreact because your mind can't tell the difference between stock market's down 2% today and the stock market's going to zero. Because in your mind, those are the same things. Mm-hmm. And then it comes back to that fear. I think most of the fear is the fear of not knowing or the fear of not being in control. It's like why people don't like to fly, right? We know flying is an immensely safe way to travel, but some people don't like it because they don't have the wheel. They're not driving the plane. It's just going up and down, and they're kind of along for the ride, yeah? So they don't have control despite the fact, and they're scared despite the fact that they know there's less than a 1 in a million chance that plane is going to crash, yes? So, and that goes back to media, right? The reason we all think our plane is going to crash is because when one does every 3 or 4 years, it's all over the news for 6 months, right? So we have a disproportionate belief there, and therefore we have a disproportionate reaction to that thing. And I think that is also true when it comes to stocks and bonds.
Yeah, I look, I can't even be in the car with my fiance driving. That's the level of control that I don't have. And this is normally the time we would take an email question, but I have a question just based on something you said a little bit earlier, where it's like if you didn't buy defense, if you're buying defense now, it's too late. And you're, I guess my question would be, so the market is always going to go up, right? We've covered that all morning. Is it though? Like, what is there a number that it can fully get to, or is it just like, can it be like 30,000? Can it be 100,000?
Sure, it will be.
So it's never just like too late to buy into America.
That's my opinion. That is my opinion. And so let's give context to the defense stock question, right? Whether it's Northrop or Lockheed or Boeing or whatever it is, right? Let's give context. I'm not saying you shouldn't buy those stocks, but you shouldn't buy them if you believe the big run's coming because Russia's in Ukraine. That did happen, but the reason somebody benefited from that was not because they woke up one morning like, I wonder what Putin's thinking today. Nobody did that other than maybe Putin, right? So who did benefit from Boeing going up and Northrop going up and Lockheed going up is somebody who had a diversified portfolio of stocks, which happened to include a couple of those, right? Because they said, I need a little energy, I need a little pharmaceutical, I need a little retail, I need a little consumer discretion, maybe some utilities. If that was part of your discipline process, you benefited from that, yes? But if you said now, after the horses are out of the barn running through the field, hey man, I think this is a good time to buy defense because it already something that already happened. Yes?
Yeah.
So that's not a strategy. So again, should you buy Lockheed? Maybe. Should you buy Northrop? Maybe. If you're going to buy them for the next 10 or 20 years, sure, why not? They're not going anywhere. So the reality is, doing it for the right reason, which is part of your disciplined and well-thought-out portfolio, yes. Doing it because you think they're going to double again because something else bad is going to happen or they're going to invade Poland. I mean, I can't say that would be wrong. If Putin went into Poland or Eastern Europe, we'd have a whole nother problem. But, yeah, I guess energy stocks would continue to do well, but you can't know that.
I guess my other question would be, I got into it with somebody online because I like to do that. I don't know much about this, but it's when it comes to like stocks, like they're like, you got to get just all your stocks should be stocks that pay dividends. Dividends is what you want all the time. You got a stock that doesn't have dividends, you're an idiot.
Wow.
Was that person correct?
No, not necessarily. You're not necessarily an idiot. I mean, there are other reasons you're an idiot, but that's not one of them.
You're focusing on the wrong part of the question.
Sorry, my bad. I got distracted. Yeah, so that's that person's. This is what is. There's such this binary thinking. This is having an advisor is good, having an advisor is bad. Annuities are bad, annuities are good. Mutual, on and on. There's no good or bad. There's no right or wrong. There's no absolutes. That's what's maybe the most frustrating thing to me is people talk in absolutes. There are no absolutes. There's many different ways. It's like a golf swing. You walk up and the guy's got the ugliest golf swing you ever saw in your life, and he shoots a 78, and you're like, ooh, never mind. So you don't. There's more than one way to skin that cat. Yes. Am I getting in trouble for saying skin? Can you still say skin in that cat?
As long as it's a hypothetical one. Sure.
Yes. Yeah. I won't skin any real cats. But there's more than one way to do that, and I think that person, maybe their point is if you're a long-term investor and the stock market languishes, for example, the 70s, the market languished. It really there wasn't a lot of growth per se in the price per share of equities in the 70s, but a lot of your return came from the dividend, right? So you're in 3.5%, 4% in dividends. Yeah, maybe the stock went up a little bit, 1% or something, but you ended up making 4 or 5 because of dividends. So there's value in that conversation, but on the other side of the coin, stocks like Amazon and Netflix and Tesla still doesn't pay a dividend. Am I correct?
You're right, yeah.
Yeah, so if you bought Tesla and that guy said, you're an idiot, that doesn't pay a dividend, well, you're an idiot with several $1 million now if you'd bought it a few years ago. So, again, let's get away from these absolute I know better than you conversations, because a lot of that I find is, I want to convince myself that what I've done is the correct thing to have done. And that comes back to the competitive critical thinking that people have, where if other people don't agree with me, and we can get into a lot of topics on this, if other people don't agree with me on this thing, that sheds doubt on the thing that I believe, and I don't like that.
Well, no one likes to be challenged.
No.
Which is why Facebook arguments are such a nightmare in the first place.
Oh, yeah.
I would venture to say not one mind has ever been changed in a Facebook comment section.
No, nobody gets to the end of some long dissertation about why you're an idiot and goes, yeah, he's right, I'm an idiot.
No, that's why you got to stay off Facebook. The only place you want to be ever on the internet is EdgewaterFamilyWealth.com. Now, that's a place where you can see how smart you are by even just going on that website at all in the first place. That's step one. You want to take the first step in a financial journey? EdgewaterFamilyWealth.com. That'll put you in contact with Scott. And they also have all kinds of content on there, from Financial Talk with Tammy. They got videos, all kinds of great stuff. You can also email us, EdgewaterFamilyWealth@RaymondJames.com. And that is what you want to do. Scott, Tammy, it has been a wonderful day hanging out with you, fellas.
Great to be here.
Likewise.
All right, and we'll see you next time on It's Only Money on Real Radio 104.1.
Yeah, and clearly people are rich, right? Or wealthy. You don't have to be rich. I like the term wealthy better. I mean, to rich reminds me of like the Monopoly guy or something. But, they're people, they're regular people.
Now that guy I trust.
Yeah,
See, the problem, Scott, you don't have a monocle.
Monocle is, now, if you can meet a guy with a monocle, I mean, like, I'm all in.
What was his financial advice? He said buy Park Place?
Where is that?
Where is that? I can't find it.
Tune in to It's Only Money with Scott Brown from Edgewater Family Wealth, Sunday mornings at 7 on Real Radio 104.1. Raymond James Financial Services, Inc., member FINRA SIPC. Edgewater Family Wealth is not a broker-dealer, is independent of RJFS.